And I'm just going to welcome everybody to the September General Membership Meeting. This is a webinar, and we ask that you type your questions using the question and answer feature. We have our speaker who we'll be introducing in a moment. And I wanted to let you know a little bit about our remaining end of year schedule. We're expecting our fourth and final speaker series on November 8th, and we're expecting to have our installation on December 6th. So I'll ask you to mark your calendars now. And now a quick word from today's sponsor, Homo Rosuli of Omaha Mutual Reverse Lending. She wasn't able to join us live today, but she was kind enough to record a short video for us. So we'll play that and then we'll get going.
Good morning. This is Homo Rasuli, reverse mortgage specialist with Mutual of Omaha Reverse Mortgages. First, I wanted to say thank you for all your support and trusting me with your clients. I am talking to you from Munich, Germany. I'm sorry to miss you all. I wanted to also mention about the jumbo reverse mortgages for purchase that we can go up to $4 million home. So if you have any clients that they can use or get a line of credit, please give me a call. I'm looking forward to hearing back from you. Have a wonderful day. Thank you again for your support.
All right. Thank you to Huma for making it to us, even while she's on the other side of the globe. I love that. So good morning, everyone. I'm Logan Link, your 2022 Marin Realtors President. We're super excited about today. We'll be hearing from Jordan Levine. But before we get to that, just a couple of things. As Romeo mentioned, we have a lot coming up for these last few months of the year. So mark your calendars for two main dates. First is November 8th. That is our final speaker series event of the year, and that will be a virtual speaker series. And on December 6th, we have our installation. And I'm hearing that will probably be in person. So mark your calendars for November 8th and December 6th. We are also working on something very cool that we don't have the dates yet, but we're doing a highlight on Marin County schools. So we're coordinating a few different school tours, possibly a panel, still in the works, but stay tuned. That's kind of an October activity. All right, so without further ado, I would like to welcome Jordan Levine. Jordan is the Vice President and Chief Economist of the California Association of Realtors. So he is responsible for CAR's housing market and economic research, as well as policy analysis for legislative and government affairs efforts. So Jordan is full of knowledge. He's a great speaker. He provides insights to CAR's 200,000 members. So we're super glad to have him here today. Thank you, Jordan. I will let you take it away, and then we will do a little Q&A at the end. So if you have questions that come up during the presentation, pop them into the Q&A. We'll get to everything that we can.
Great. Logan, thank you so much. And thanks to Romeo and everybody at the association for the opportunity to speak to you. I'm going to share my slides so that you don't have to look at my face the whole time. And, we have some good pictures and try and get you up to speed on what's happening in the broader economy and then how that's all kind of playing out in the housing market, because of course the economy is kind of a fundamental building block of what happens in the housing market. And the good news is that all that stuff that kind of, triggers housing market changes is still happening, right? People are still having babies, people are still getting married, getting divorced, all of that stuff. Mom's kicking the kids out of the house finally, and all of those things are still happening in the background. This is more about kind of staying up to speed on the currents, because for me, as scary as the headlines are, I think the reality is that when the market shifts, that's when you really thrive and not just survive. I think that, on the one hand, consumers need us more than ever. And I think that's, part of the recipe for success is to really, hitch your horse to the consumer's buggy and really be in it together with them. When you look at the current economic data, the good news is that we're not in a recession yet, right? When you look at all measures of current economic activity, they're still moving in the right direction. Even those weekly indicators that we get right up through last week haven't really shown significant deterioration. On top of that, we've got much better fundamentals than we had going into the last financial crisis back in 2008. We had, it's not 2008 all over again, and we'll talk a little bit about how we have much more to kind of fall back on than we did, whether it's with savings, home equity, much more strongly underwritten mortgage market, not just over the last couple of years, but over the last decade. The kind of bad news is that I do think we're in for some turbulent economic times, right? I think that the bond market remains really spooked by short run economic prospects. And we'll talk a little bit about what that might hint at. My biggest concern, frankly, is with consumers. Inflation is really taking a toll on their ability to just keep spending going and keep this economy growing. We're still about a 70% consumer driven economy. And so we want to make sure that we're keeping an eye on consumers, because as consumers go, so goes the kind of broader macroeconomic environment. Housing, though, is not on the precipice. We have seen a market shift for sure, but prices are still rising, albeit at a slower clip. And actually, we're seeing signs that sales may be finding bottom quicker than we anticipated. This is mostly an interest rate driven shock, and it could be one that we're adjusting to fairly rapidly. We do think sales are going to remain low, and we might even see prices dip a little bit. But again, we have much stronger fundamentals coming into this. And ultimately, when you look at California's, just kind of 30,000 foot view, we have a lot more people now than we did a few decades ago, and not as many homes to put them in. And that means that, any price volatility that we do see will be temporary, and that long run trend for prices is always up. And I think buyers and sellers kind of forget that when you get bogged down with the latest headline. And again, I think it all comes down to, for us as individual real estate practitioners, to kind of step up our game, right? I think, again, the consumer needs us more than ever. They're buying in markets they don't have a lot of experience in. They're buying new product types. You got remote workers who are looking in all these different areas. And that's a good thing, right? Because they need us. But it also means, again, that we got to bring our A game and kind of be that advisor in chief, and make sure that we're giving the perspective, that we're giving them the long-term view, and that we're asking the right questions. We're not there to convince anybody of anything, but we're there to kind of point out some of the things that those major headlines are missing, that rates are still relatively low. If you're a buyer, the market's not as competitive. That's good for you, right? As a seller, you can still expect to sell your home quickly. We still have a lot of homes that are selling at or above list price. And so, again, it's about asking the right questions, giving them that perspective, and being that market expert to help them navigate this changing marketplace. And I think that's how you not just, again, survive, but thrive and have clients for life and referrals from their kids and grandkids, because you just did such a great job. And I think that, again, is what it all kind of boils down to. Let's talk about why the economy isn't quite as bad as you may have read in the newspapers. First and foremost, for me, is the labor market, right? When people are working, when their incomes are rising, that is the kind of step zero when it comes to housing, right? You've got to be employed to get out there and buy or rent and move to a new place and things like that. And when you look at the jobs numbers, you can see that we're almost fully recovered. We have just 74,000 jobs to go to get back to where we were. And I fully expect that we'll exceed that when we get the number for August here on Friday. We've recovered all of the 2.8 million jobs roughly that we lost at the onset of the pandemic, but even more so than how the order of magnitude, the size of the recovery is just how consistent it's been. That's why I wanted to bring this chart, is just to show you that even with all the ups and downs and the flare-ups with new variants, and we're locking down again, and the masking, peds, all of that stuff, it's been very turbulent out there, and yet the economy has continued to recover on a very consistent basis, again, with no signs that that's been deteriorating over the very short run, right? We still have about 780,000 or 800,000 jobs probably to get back to the long run trend line. But again, California is basically 97% of the way towards full economic recovery thus far. And people that want to work are largely employed. And you can see that California's unemployment rate, although again, we don't have the August number yet, already dipped below 4%. And that's not low just relative to where we were a couple of years ago. But you can see if you glance back over the long run, right, that is a very low level of unemployment. Again, most people that want to work have jobs. When you see how that shakes out across the state, these are markets sorted from most affected on the left to least impacted by the pandemic, at least in terms of job losses on the right. And you can see that, that 97% jobs recovery is fairly broad-based. Places like Marin, where leisure, hospitality, hotels, restaurants, et cetera, play a bigger role in the local market, just because you're, such a nice place and everybody kind of comes in and spends their money from all these other markets there, is lagging behind the curve a little bit. But even there, we're more than halfway. We're about 2/3 of the way towards full economic recovery. And so again, people that are looking for jobs largely have found them at this point. There's no signs that the economy is abruptly reversing course, even in the face of higher rates and rising inflation and increased economic uncertainty, frankly. But when you look forward, we are kind of bracing for a modest economic recession coming in 2023. It's not 2008 all over again. We don't have those same fundamental imbalances, but the economy is shifting, and we see that the costs of the inflation are starting to outweigh some of the benefits of a robust labor market. You can see, actually, we just got a new number this morning, which I didn't have a chance to throw in, but CPI is down from those 40-year peaks that we had a few months ago, but it's still running relatively hot. And all the experts, including us, but you can see the UCLA forecast here, just so that you don't have to take our word for it, that we expect, even as inflation continues to get under control, it's going to be a drawn out process, right? We're expecting above trend CPI all the way through the end of 2023 before it gets back to something that looks more like normal. And that's due to both this supply chain issues that we've had because of the pandemic, and also just because the labor market is increasingly tight. We got a lot of folks who haven't re-entered the labor force in the face of the pandemic for a variety of reasons, meaning that even as we get inflation under control, it's going to be a kind of drawn out and painful process. We've already had 2 quarters of negative GDP growth. GDP is the kind of econ nerds way of saying how many dollars and cents are out there flowing around in our economy at any given time. And unlike the jobs numbers, GDP hadn't fully recovered, and we've now kind of stalled out and seen 2 quarters of modest negative growth. Some folks will tell you that's the official definition of a recession. I don't agree. I think it's a much more subjective definition that's determined by the folks at NBER, who have the ability to declare recession. But nonetheless, it is still a troubling sign, right, that we're not able to maintain that economic momentum, because in large part, all of the growth that we're seeing in nominal terms is being consumed by rising cost of inputs and labor and gas and all of that stuff. Why do I focus so much on the consumer? Here's GDP broken down across the various segments of the economy. And trust me, even though this is kind of esoteric macroeconomic stuff, I'm going somewhere with this, because I think consumers are probably our biggest risk at this point. Consumption is 7 out of every $10 in the US economy. You could see business investment, residential, non-residential, construction, international trade, government spending, all of that equates to just about 30% of the overall economy. So again, where consumers go, so goes the rest of the economy, especially when it comes to growth over the last year, right? Much of the recovery that we've experienced to date has come from increases in consumer spending as folks got out there and started spending money again after the shutdown, right? And why does that concern me? Because if you look at the sources of that consumer spending boom, it's really come from 2 places, right? One is we've drawn down a lot of the savings that we got when Uncle Sam was depositing checks in our bank accounts. We went out and bought cars and TVs and all of that stuff at the cost of our savings rate. And we've also run up more debt, right? We're putting more money on auto loans, and that was a big part of the growth that we saw in 2021. But more recently, you can see on the right-hand side, the growth in consumer credit has been coming more from revolving debt, which means credit cards, right? And so you can only draw savings down to 0 or run the credit cards up till they're maxed out before you have to start to take a step back. And I think up to this point, this is kind of the story of how we've been able to grapple with rising costs of haircuts and gas and rents and all of that stuff. But there's a limit to how much we can expect consumers to continue to kind of propel the economy, and why we expect a modest recession, even though we're not on the precipice, as it were, with deep fundamental imbalances like we had back in 2008. And you can see here one of my favorite indicators for predicting a recession, and you can see these gray bars here are periods of recession going back historically, but this is real net worth per capita, year-to-year growth in real net worth per capita. So this is people's actual wealth after you inflation adjust it and divide it by the number of people out there. And you can see that when people are getting poorer, the economy generally has a tougher time. And even though net wealth is still increasing in real terms, inflation and increased population is starting to erode the benefits of an elevated stock market and home prices that have risen tremendously over the course of the last couple of years. And I think that's a relevant indicator as well in the context of a market with still a lot of volatility. I think you could easily argue that equity markets are still potentially overvalued. And I think they're down again this morning on the back of that CPI report, meaning that we could see this drop into negative territory, right? And we also have the kind of Fed playing increased role in the broader macro economy right now through their monetary policy. You can see this is the latest dot plot from the June meeting that the Fed had, and all of the Fed Reserve governors more or less think we need a Fed funds rate of about 3.25% to 3.75%, not just in 2023, but pretty much throughout the balance of 2024 as well. And that means that we're going to see probably elevated rates, and that is having certainly an impact on the bond market. What I'm showing you here is the yields on 2-year and 10-year treasuries, and you can see that the yellow line has actually been above the green line for a long time. And I won't bore you with the minutia of how the bond market works, but usually the longer you loan someone money, the more you're charging them in interest. And when that pattern reverses itself, it suggests that there's limited appetite for 2-year bonds, right? That the bond market is having to offer higher and higher returns or lower the price, or however you look at the bond market prices, in order to get people to buy that. And that's because they're scared about the short run prospects of the economy, about inflation persisting, and also about recession. And that, again, is another one of these indicators where when the 2-year crosses that 10-year note, it's been fairly predictive of a recession. And you can see this, what the econ nerds would call an inversion of the yield curve. Every time that 2-year goes above the 10 over the last 3 to 4 decades, it's been followed by a recession. And you can see where we've been at over the course of the last couple of months. So even as we're not plagued by deep fundamental imbalances of unsustainable borrowing and lending and lots of leverage in the financial sector and all of that stuff, I do think that consumers are not going to be able to continue to propel us forward as we move into 2023, even though we're not in a recession yet and most people still have jobs. The good news is that it's not 2008 all over again, right? We're not going to see a major foreclosure crisis that brings prices down by 30 and 40% the way that we did last time. One major thing that gives me a lot of confidence is the mortgage market. What I'm showing you here is both FICO scores for new purchase loans, right? And you can see that not just over the last couple of years when the typical FICO score was in the 730 range, but going all the way back to the end of the financial crisis, we've been underwriting at a very high level. These are very credit-worthy individuals. We were kind of skimming the cream, as it were, of borrowers, and basically these are folks who weren't coming in with these ninja loans, if you remember those, the no income, no job or asset type of just stated income, pick a pay, not even covering the amortization where your loan resets and kind of blows up in your face and all of that stuff. These were strongly underwritten loans to the most credit-worthy individuals. And you can see the same kind of story when it comes to debt to income, right? These weren't people that were stretching incredibly far in order to make it happen. There's, the economy has produced a lot of very high income jobs over the course of the last couple of years, created a lot of wealth. And those are largely the folks that were getting into housing. And when you look at it, at where we're at in the wake of the forbearance and foreclosure moratorium and all of that stuff, California has almost 98% of its mortgages that are current. This is through the second quarter. We won't get the third quarter number until we close out in September. But you can see that Californians in particular, although the rest of the nation doesn't have a huge problem to speak of necessarily either, but California in particular had folks that really prioritized housing. And I think given the nature of the crisis and how the pandemic made our homes more important to us than ever before, that kind of makes sense. They'll let you repo their car, you know what I mean? They'll kind of go BK on a credit card, but they made sure that they kept those rents and mortgages current. When you look at the kind of folks that went into forbearance, right, there's not a lot of systemic risk coming out of the backside of that program either. So, I'm hearing all about this foreclosure crisis. And actually, if you read reports, foreclosures are up like 80-90% from where they were last year. It's like, yeah, we didn't do any foreclosures last year. If you have $1 and I give you another $1, you got 100% raise, but you still only got $2. That's kind of where we're at with foreclosures right now. And I don't have a lot of concern that we're on the precipice either, because almost 20% of the people who went into forbearance and then subsequently got kicked out when the program ended this year, never even missed any payments. They used it as an insurance policy, just purely as a, what happens, a what if I lose my job, right? And never actually missed payments. So we don't have to worry about those folks, right? You have about 12% who missed some payments, but already got caught back up. And, assuming that they're part of that 98 or 97% of folks who have gotten their jobs back already, not much of a concern there. We had a tiny sliver that re-amortized their existing loan. But the thing that really encourages me is that almost 30% took these missed payments and actually moved them to the end of the loan. This tells me not just that it's a huge chunk of the folks who got into trouble, but and that there's no balloon payment, of like 15, 17 months that you got to come up with eventually just to get back or stay in the house at the end of the program. But that banks and the government and borrowers all kind of knew that we were in it together this time, which was a huge change from 2008. We had 15% actually modify their loans, stretch it out for another 30 years, take advantage of those super low interest rates. And many of these folks actually have lower mortgage payments today than they had back in 2020. And again, assuming that they're back to work, not much to worry about there. 7% did get into trouble, but unlike last time, they had home equity, right? They put money down. These were, again, very tightly underwritten loans, and maybe they got into trouble, lost a job because of the pandemic or what have you, but were able to sell that home and probably even put some money in their pocket to get through to better times. And so the bottom line is that there's only about 17-18% of the roughly 8% of all loans that ever went into forbearance in the first place, meaning that we'll probably see, single digits in the foreclosures. It's not going to be zero. Not everyone's going to be able to hang on, but we're not going to see that kind of 60-70%. If you take 17% of 8%, you're talking about low single digits when it comes to foreclosures. Where the Fed is playing or having a bigger, role is not in creating a foreclosure crisis, because again, we have much better fundamentals, but, rates have gone up pretty significantly under this regime of kind of monetary policy tightening. The latest number was about 5.9%. from the Freddie Mac number, and that has an impact on the cost of borrowing. I know the statewide median of roughly 900,000 is kind of low by Marin County standards, but this is just a thought experiment that says what happens to the payment on the median priced home in California as rates go up. And just going from 3 to 5%, which we've already done, adds about $830 a month to the mortgage payment on that exact same home. Going up to 6%, which we're on the precipice of doing now, adds another $400 to $500 a month. And so it really erodes the purchasing power of consumers. And rather than being able to absorb these increased rates, what it means is that you qualify now for less borrowing, right? So at 3%, this kind of median household of 196,000 or median buyer household, goes from being able to afford a $1.1 million home at 3% to an $825,000 home at 6% in order to keep that same kind of monthly payment and have all the DTI ratios and all of that stuff work out, which is why it might make sense to jump in before rates rise any further. You also see folks taking advantage of all kinds of different loan options again that we haven't seen in quite some time, and a lot of buyers using adjustable rate mortgages. We're seeing supply and demand really, contrary to what you read in the paper, we're not on the kind of beginnings of the end. You're seeing supply and demand work as we would expect it to work. The good news is my student loans have been vindicated, right, by this shift, because when you have a market that's running so hot and so incredibly imbalanced, when you have this huge surge in buyer demand because the pandemic made our homes more important to us than ever before, gave us flexibility with remote work and the lowest rates for mortgages that we've ever seen, at the exact same time that we had a huge pullback in inventory because we were in a pandemic. People didn't want to put their home on the market and deal with open houses and PED forms. They just didn't want people coming through their homes, and it led to this incredibly not even red hot, but white hot market. And as that market persisted, it, caused the market mechanism to kick into gear. And what you see is that, some folks with the increase in rates, the reduced affordability because prices have shot up, and with the kind of negativity that you read about in the media, has had an effect on buyer demand. Pending sales are falling by double digits now statewide. And when you look at the mortgage applications, those are falling, and we expected them to fall this year, right? When you look at 2020 and 2021, we were running a 12 to 15 year high for buyer demand. Again, that white hot market where there was this insatiable appetite. So we knew demand was going to be stepping back from these levels. And that's part of what you see baked into these numbers that's getting kind of, I would say, jumped on, be able to sell more newspapers. That being said, we are also now falling fairly consistently below 2018 and 2019 levels, and so the negativity is working its magic, as it were. And unfortunately, a lot of buyers missed out on 5% rates over the last couple of months because they're waiting for that foreclosure crisis that's probably never gonna come. And when you look at closed sales, you can see there too that we had one of the worst months that we've seen in a long time, as mortgage rates were surging and there was rising economic uncertainty. We expected to be down from last year's levels, but this is a real honest to goodness decline in home sales. And so again, I think it's really about refocusing the consumer on the long run and away from the possibility of a recession over the next couple of years, because again, when you zoom out those charts, the benefits of home ownership remain very much alive and well. I love this chart because it shows why the shift is as significant as we've seen, right? At the beginning of the recovery in 2021, these are year-to-year growth rates in transactions in California broken out by price segment. And you could see that the top end really took off, right? That the market opened up and we were getting good growth of double digits across the board. But 2, 3, 5 million and up were growing by triple digits. Last summer, actually, we were seeing 300% and 400% growth at the very top end of the market. But as we kind of burned through that inventory, as it created so much price growth and competitiveness, what you saw was that it started to eat into sales at the bottom end of the market. Folks were starting to be priced out, and especially as rates started to tick up, the top end was really the only thing holding us together. And the reason why we were still getting good growth in the first quarter of this year was that we were still getting double digits at the very top end of the market. But even now that has succumbed to these kind of broader macro trends. And you see that we're now in decline by double digits, even at the top end. And so that was really what was giving us those incredible rates of growth, was that, we were having strong sales performance across the board, but especially at the very highest end, people really wanted to put their money in real estate. And part of the declines that we're seeing are a result of increases that were just so through the roof last year. We're seeing a similar story play itself out countywide in Marin County. This is through the first 7 months of the year. I'll have the August data here in another day or two, but you can see that same kind of a trend playing out, where we had this kind of sustained double-digit growth in 2020 and 2021 that we've now started to moderate back towards pre-pandemic levels. The incredible growth from last year exaggerates the growth rates that you see here. I know 22% is a pretty scary number, but if you again zoom out the charts and look at kind of the historical average, Marin County does about 170 transactions or so a month. And guess what? That's about exactly the number that you did in August of 2022 as well. We just don't have that kind of huge surge that we had persisting, really starting at the beginning of the recovery in 2020, but really maintaining that in 2021 as well. So this is, again, a market mechanism that's working as you would expect. Supply and demand coming more into balance. Buyer demand stepping back for a variety of reasons. Sellers being encouraged by the high prices and the fact that they can sell it quick and not have to do much negotiating. Not a market that is kind of in free fall mode. In fact, you can see there that it looks like the August number is going to be up quite a bit from where it was in July. Don't hold me to that. We're still tweaking the final numbers. But again, what happens when a market comes more in balance with supply and demand is that you have prices that don't grow by 35-40% anymore. They're still up about 2.8% on a year-to-year basis in California as a whole, right? We're still running about all-time high prices for any July, and actually it looks like the August number will still hold up relatively good too. Marin County has a $1.7-ish million median price, which is down about 1.7% from where we were. But again, keep in mind that these are median prices. So when we don't have 300% growth in 2, 4, 5 million and up, it impacts these numbers, but we are still kind of seeing that impact of affordability and just a shift away from the top end that's not dragging those median prices up as high, playing itself out locally too. What's interesting though, and why I don't think that we're on the precipice when it comes to prices, even as that top end will probably continue to go back towards something more normal, is that yes, we've seen more inventory come online. We have the highest level of active listings now that we've seen in a couple of years, going back even actually before the start of the pandemic. But this is more a function of sales slowing down than it is kind of sellers heading for the exits, as it were. In fact, this is active listings. How many are on the MLS every day that we log in across the state, broken out by price segment? But when you look at the stock versus the flow, right, this is just a snapshot of how many are out there, and ask why has that number gone up? Is it because sales have slowed down or because of sellers really dumping properties? You can see that it's the former, not the latter. In fact, we're putting on basically the same number of homes this year that we have been over the last couple of years. There's no flood of new inventory coming onto the market. You don't see buyers trying to cash in and head for the hills. In fact, a lot of these sellers heading for the hills, right? You have these sellers in many cases sitting on 2.65% mortgages and just going, you know what, I'm going to wait and see what happens, right? And to me, that's encouraging, because in order for prices to really kind of fall through the bottom, you would need a lot more inventory coming online, not just sales that are slowing down as people kind of adjust to the effect of these higher rates. And actually, when you look at the monthly data, right, and that's one of the upshots of the pandemic, is that we started collecting data on a much more frequent basis. So I can report to you almost in real time that closed sales actually went up a bit in August from where they were in July. And so again, even though we don't expect a rapid recovery and we're still adjusting to these higher rates, this suggests that it might be a fairly quick adjustment process. And when you look at the pending numbers for August as well, it suggests that we should be encouraged about September and October too. Again, we're not going to rocket back to 500,000 units. We were still at about a 300,000 unit pace in July. So we might get back above 300,000, but nonetheless, we're not going to see that kind of continued acceleration or decline when it comes to the housing market. You've still got a lot of folks that want to take advantage of rates that are near historic lows. So again, it's about zooming out the charts and giving that perspective. We're in a market shift for sure, but market shifts actually create a lot of opportunities for buyers and sellers, especially when you look at the long run, right? Because even as we have some shifting away from the top end, infecting that median price and giving us a bit of a price decline next year, when you ask whether it's a good time to buy a house in California or not, I think it's imperative that you look to the long run fundamentals, because we have 15 million roughly more people today in California than we had 20, 30 years ago, and we build about a third as many homes as we did back in the 80s. And so from that standpoint, any price volatility that we do see is going to be temporary, because we still have too many people and not enough homes to put them in. And that's why when you look at the kind of long run trajectory of home prices, that's the one and only way that people create wealth in this country. And so even if we have a modest dip back towards that long run trend line, again, the trajectory is still always up. It's also still a great time to borrow money to get your foot on that property ladder, right? I always joke that I'm the son of a guy who in the 80s used to brag about his 12.5% mortgage interest rate, right? And so yes, 5.89 last week is higher than 2.65, which was an all-time low late last year, early this year. But guess what? You're hard pressed to go back at another point in time outside of that to find rates that are lower than they are right now. And guess what? With the Fed, maintaining their commitment to keep their foot on the accelerator when it comes to getting inflation under control, that rate's probably going to go higher, right? And so again, it's not about convincing you to buy now or anything like that, but just pointing out that rates are still low and probably going to go up. And we're still in an environment where, you haven't seen rates lower than this in basically most of modern history, right? And again, with the long run price trajectory going up, do you want to be the one that's accumulating wealth, or the one that's sitting there, kicking yourself for not having gotten your foot on the property ladder and created all those opportunities for your kids and grandkids and all of that stuff? And so, yes, we have sales that are going to be, down this year. We have a worst case that's a little bit lower even than what our baseline projection is, but we're still looking at sales in excess of 300,000, right? You still, again, have people getting married, having babies, getting kicked out of their wife's house. All of that stuff is going on in the background. You've got a labor market that's still really robust and rates that are still low. And so even though we're coming down from 12 to 15-year highs last year, right, there's going to be still a lot of demand for homes out there. And we still have a lot of high wage income earners, income renters, actually, that we can still peel off into home ownership before rates get any higher. We do have a 7% price decline next year, and you can see that here. Part of that, about half of which, is because the top end of the market won't be growing by 350% anymore. But we do have a modest decline just overall in prices. But I wanted to zoom that out for you too, because with the exception of this year, which is going to be a record high prices are still up over the long run. And I want you to just keep that long run supply and demand picture in place. A market is rebalancing after being incredibly robust. We preloaded a lot of the next couple of years of growth into last year's 35% increase. We're not on the brink of having prices somehow suddenly reverse course when we're a state that's 15 million people bigger than we used to be. And so I think that is why, even though my quantitative forecast may seem relatively pessimistic, I'm still very optimistic for real estate. Again, the benefits of home ownership are alive and well. It still makes sense to buy a home. I wish I had more money to go out and buy properties right now so I could just keep them in my back pocket, because guess what this chart's going to look like about 7 inches further to the right of this screen in about a decade from now. We're going to look back and go, man, we should have bought when it was 900,000, and as crazy as that sounds, again, I'm the son of a guy who bought a $70,000 house in the late 1970s and wondered, what am I doing and how am I ever going to pay for this? And that house is now worth about $1 million. And so that's what it's all about. And I think it's about keeping it in perspective, being that market expert. I gave you the forecast chart itself, so you have all the gory detail if you want to go through and study the numbers. I'll also make sure Romeo gets a copy of this slide deck as well, if you want to use this for those conversations, to zoom it out and give your clients some of that perspective. But I think it's important because consumers do need us more than ever. whatever, but we just have to bring our A game to help them through this shift. And that's how you'll not just survive and get, a lot of listings and transactions this year, but, you'll have all those folks in your kind of network going forward that will make you a superstar for years to come. And so with that, I will leave it there. And again, say thank you to Logan and to Romeo for the opportunity. And I'll look at the Q&A now. If I haven't beat everybody into submission yet, I can entertain questions. I have lots of time.
Amazing. Thank you so much, Jordan. This is great. And it's so nice to just see actual numbers and actual charts. So love it. Thank you. I have a question for you.
Great.
So a lot of the statistics and charts that we're looking at, mostly we're discussing California, right?
Right. Yes.
Do you have a sense of how California is performing compared to like other states in the country?
Yeah, so we're at, like we were last year, we tend to be on the leading edge. They always joke that when California sneezes, the rest of the US catches a cold economically. And you kind of saw that. We had even more robust growth in sales and prices. I think we were up about twice what we saw in the rest of the nation. And similarly, we started slowing earlier in transactions and actually slower when it comes to price growth. But what you see is that it really is a macro phenomenon. And I kind of was walking that tightrope between focusing on those broader trends and zooming into the local data, because it's mostly a macroeconomic driven show right now. Those structural issues in California are still there. Too many people, not enough homes, excess demand, lots of high wage earners wanting housing and all of that. But, the only hiccup is that broader environment where folks are now readjusting to what they can qualify for because of higher rates, right? And sellers are taking a step back and going, maybe we should wait and see. We've got a great rate and we should just stay put and see what happens and all of that stuff. But to a lesser extent, they're still seeing what kind of we're seeing. We just started seeing it a little earlier.
Okay. All right. Trendsetters. Okay. Thank
Right.
you. So we
Indeed.
have a great question from Anna Frost. Anna is wondering, what do we tell a seller who asks if they should rush to get their homes on the market now or wait until the spring, perhaps compromising on home preparation? So that's, what are your thoughts on that? Is now, in your opinion, better than the spring, or should we?
Yeah, I mean, if a seller thinks they should rush, again, I don't think we're on the precipice, right? The market is still competitive. We have still about 30% of homes statewide selling above list compared to about 75% where we were back in March, but that's still 1 out of every 3 homes. So there's not huge, price cutting or anything like that. But I do think that there's a chance, again, for a modest recession next year. And you always want to kind of get the consumer when they're at their strongest. And I think having rates that are lower now than they're likely to be next year is a feather, in your cap. I think that especially after the next Fed meeting, the folks will probably wake up to the reality that kind of reprieve that we had in rates where they kind of topped out around 5.5% and have just been sitting there for the last month or two is probably temporary. And so, I wouldn't rush. I would always just make sure that you're, have the house ready to go. Consumers we see want houses that are ready to go. And there's still kind of that demand for just the move in, ready to rock and roll. And again, it's all at the high end is still where demand is strongest. So you got to take it case by case. But the bigger thing I think is just whenever you do list it, I think just being realistic and pricing it right. And just expecting that there's not 25 buyers. There's like 12 or 13 for each one. So still competitive, but just, I would, level set expectations with those sellers and try and, give it an honest price. And I think you'll do well, no matter if it's, in the next 6 months or next week.
All right. Makes sense. And then we have a question from Elizabeth Pedrick. Elizabeth is wondering if CAR has done any analysis about how the ABAG mandated new housing quotas in the Bay Area may impact the market. So for those who are not familiar with ABAG, these are numbers sent by the state to individual counties of how many units we're required to develop within the next period of time. And in this round of housing quotas, the state is really encouraging a lot of building. Whether or not that will actually come to fruition in a place like Marin is a whole interesting, fascinating conversation that we sometimes have here at the association. But certainly there's this requirement, this push from the state to build more supply. So do you think that will have an effect, or?
I wouldn't call it a requirement because I don't think those units are going to see the light of day. You know, most of them, I mean, there's been a RENA process for a very long time where the regional housing, you know, authority, which in your guys' case is ABAG, but they have SCAG down in Southern California that does the same thing, and they take the allocation and go out and dole it out. Nothing happens if you don't meet those allocations. And the reason why I know that is because we've never come close to meeting those allocations, you know, in the last handful of housing cycles. And so, you know, I'd be impressed if we got halfway there. And I think we need to do a better job of building. And I'm kind of glad that even though they're not requirements, they're suggestions, that they're being aggressive, because they're, you know, they're not going to materialize all the way anyway. And we should try to do the best we can to get supply under control, because that's the one thing really holding California back. We could maintain a much higher level of home sales. You know, I showed you the 1985 and 2021 population and new construction, and how one was up a lot and one was down a lot. What I didn't show you was that we're, you know, the number of housing transactions, even last year at like 420,000 sales. We used to do 420,000 sales back in 1985. And, you know, that's where our affordability challenge comes from. That's why our home ownership rate is, you know, 10 percentage points lower than it is in the rest of the United States. It's not because people don't want home ownership or don't recognize the long-term value of creating wealth and all of that stuff. And so, you know, I think you don't have to be really scared about the ABAG numbers, because if the counties don't want to build that much, they're not going to. And B, that, you know, even if we get, you know, fractionally some part of the way there, it's really much needed, because the Bay Area in particular continues to crank out these incredibly great high wage jobs, even with remote work and stuff like that, right? And we need houses to put these people into. That's why you have these, you know, 1960 bungalows that are 1,500 square feet going for $2.5 million, is because these high income people got to live somewhere. And if there's not new homes for them to buy, then they bid up the cost of the existing housing. And so don't be scared, but, you know, be an advocate, because we want to keep those high worker, you know, income workers here and spending their money here and have a great economy. We want to be able to have kids that can go get great jobs and afford to live in the neighborhoods where they grew up too. So
on the note of government, Anna Frost was also wondering, as student loan forgiveness begins happening, do you think that will have any effect?
I think it'll have a modest impact. You know, it's not like everybody's getting a $10,000 check. They're going to get $10,000 forgiven off probably what is a much bigger loan. It's also going to accrue over time, right? Because it's a cash flow issue, and you may be saving $200, $300, $400, $500 a month, and that will help you save for a down payment, right? Or be able to get into a more, you know, a rent that you can afford, where you're not having to run up your credit card. But the benefits of that will take a while to accrue. It's not like all those folks are just going to be bestowed with money that they're immediately going to be able to go put that 10 grand down on a home. So I think it'll have an improvement. We do see that, you know, younger, even high wage earning folks are held back from home ownership by student loan. I do think that it will help, but I think it'll be modest, because they're still up against, you know, just a lack of homes available to buy, and still a competitive marketplace and rates that are higher and all that stuff.
What about the high end versus more of like a median or lower price point? Do you expect that there'll be much difference in the way that these markets shift?
I just think that they'll start moving more closely together. I think that you've had a lot of activity. You know, I think you've had 3 years worth of activity in 5 million and up in the last year and a half, you know, and so I think that can't continue. A lot of the people who wanted to go out and get that $5, $6, $10 million second home or just main home or whatever have largely made those moves at this point. And so we'll just see that kind of not be through the roof. And that will be the biggest difference. I think at the lower end, that's where we're plagued by inventory the most. When I, you know, do the Marin County transaction data, I do, you know, we have all these kind of preset price points and stuff. And it's funny, it's like 0 to 300, 0, you know, 300 to 600, 0. And, you know, and I think that is the challenge, is that, you know, I think San Mateo edges you guys out, but I think the required income, like if you just crunch the numbers in reverse and take like that $1.75 million median price and you back into like the minimum income you need, it's like in the $350,000 to $450,000 a year range, and that is, I think the challenge that we're up against, and why I think, the bottom end's been struggling the whole time. It never had the great bounce back recovery that even the middle segment did, of like 750 to 2 million. And that is an inventory story, and I don't think that's changing, because that's where the construction part kind of comes in, right? You've got to build new, relatively expensive housing for these high wage earners, so that we free up the older, more affordable housing stock for first-time home buyers.
So as we take this information out into the field, so we have, for sellers, your good advice of, prepare well, make sure things are done correctly, because buyers are still interested in properties that are ready to go and well presented, right? But kind of be mindful of the fact that we don't necessarily know where things are going, and it is a good idea to try to be there while rates are good, right?
Yep.
On the buyer side of things, what would you say to a buyer right now? Do you feel like now's the time to get in because rates are lower, they might go up? Like, how much do you think they'll go up? Or is the market maybe going down, so it makes sense to wait? What would be your thought?
Yeah, I think it depends. I would say, what's your timeline, right? If you're buying over the next year and a half and you're trying to buy low and sell high and time the market, then this probably isn't the best, times of economic uncertainty in general, not just right now, but the more uncertainty there is, then the more short run risk there is, right? And so, but if you're buying a home to live there and raise your kids and send them to Marin High School and all of that, and you're going to be in that home for 15 years, I have absolute confidence that if you take that long run price chart and look at, again, we're going to be saying, man, remember the good old days when, Marin County prices were 1.75 million, right? And wishing that we would have bought. And I think that is, relevant, again, depending on your timeline. If you're buying to live there, rates are going to go up, prices will go up over the long haul. The benefits of home ownership, I think, are alive and well. The other thing is, the competitiveness having downshifted is good for you as a buyer. Market shifts away from being red hot are great for buyers. Sellers are more realistic. They're pricing it more correctly. They're more willing to negotiate, right? You have homes that they're still selling quick, but they're not selling within 6 days on median the way that they were last summer, right? And so there's more inventory to choose from. You have sellers that may be willing to negotiate. You have homes that maybe they're not priced through the roof the way that they were before. You don't have all these all cash folks in the same volumes that we had before. So I just think the kind of Main Street buyer who just wants to be the owner occupant but had financing and couldn't get in before has a chance now, especially before rates go up, and to get in, where long run prices are still poised to be up significantly from where they are now.
That's good advice. I think bringing that kind of long-term zoom out chart to the attention of buyers is a very positive thing, right? Kind of put it into perspective. Go for it when you're emotionally ready and financially able, is what I like to say. So I like hearing.
Yeah, and I think that structural one is really good too, right? It's easy for folks to understand. You can't build 300,000 units 40 years ago and then add 15 million people and start building 100,000 units a year and expect prices to do anything but go up. We've all been to a popular concert. The more people lined up out front, the more scalpers are out there charging $1,000, right?
There you go. That's a great point. Perfect analogy. All right, Jordan. Well, we are approaching 1 hour. And so I want to say thank you so much. This has been great. Thank you for taking the time to answer our questions as well. We appreciate the insight. And thank you everyone for joining us and for listening in today. If you would like to hear more on this topic, you might be interested in the speaker series panel that we did a couple of weeks back with Ali Furnesi, Linda Gridley, and Jen Pfeiffer. We talked about what we're seeing in the market kind of from a boots on the ground perspective and how we're approaching things in the fall. So you can find that on the Marin Realtors Association YouTube page and in last week's Realtor Rundown email, which comes out every Monday. And we will send this presentation out to everyone who is here today. We'll send it out within the next day or so. And then also keep an eye out in the Realtor Rundown for the recording and perhaps for Jordan's slides as well. All right. Thank you, everybody. And thank you again to our sponsor, Huma Rasoli. We are so grateful. All right. Go out there and do your thing.
Thank you.
Bye, everybody. See you next time.